She's in Sydney. She's
Sydney
in the Bell
studio.
Direct Sydney studio.
G'day, Julia. Thanks
hey,
for
Julia.
joining us.
Hi, how are you doing?
So, look, we were just talking then about this Tuesday was a stronger day. Today, we're giving back all of those gains. What's kind of behind the movement?
It is a bit disappointing for the Australian share market, especially given that we are seeing markets around the region rallying, and in particular we're watching the Shanghai Composite, which is bouncing back, and that's after it does look like the US and China are ready to get down and talk again around the possible trade deal. So that has the market excited, and markets around the region are rallying. And I guess on our market, it's only the material sector which is benefiting. So overnight we did see US officials led by Treasury Secretary Stephen Mnuchin extending an invitation to Chinese counterparts to hold bilateral meetings. So I think this is pretty exciting, given that this week we did see the Shanghai Composite, the lowest since January 2016, and pretty close to testing levels that we haven't seen since 2014. So if we do see a compromise being made, we could see the Chinese market rallying back and popping in. Today, the Shanghai Composite certainly doing well with a rise of about 0.9%.
Yeah, more impressive than that, though, the Hang Seng, the market moving into bear market territory this week. It's up by 1.5%. We will see if the momentum can last. Chris Weston from IG was of the view that at least when it comes to some of the buying on the mainland Chinese market, that it's a lot of sort of short positioning because it's been sold down so significantly. Just back to, I guess, some of the company news out there today, Julia. We've got Centuria Industrial REIT saying that it has confirmed this bid that's come from Property Link. It's a $541 million offer. What do you make of it?
Look, we've seen a lot of M&A in that property space, whether it's Westfield, Univale, Gateway Lifestyle with Brookfield and Hometown, looking at that, and Healthscope looking to spin off into their property into a separate vehicle. And then today we've also heard from Investor Office Fund, which has received a fresh bid from Oxford Properties at $5.60, which was 10 cents more than they bid and 8 cents more than the Blackstone bid. And then, as you mentioned, Nadine, you have Property Link, which last night acquired 5% in Centuria Industrial at $2.99, which at the time was around about a 10% premium to the close yesterday, and then quickly moved to a 10% stake and then announced a 12.3% stake. So what we're looking at here is a hostile bid. There's a $755 million proposal on the table. And if it is successful, combined, the company will be the largest industrial property play here in Australia. But look, it is heavily script weighted. It's 2.5327 Property Link shares and 33 cents cash. And I guess at this point in the cycle, what you are finding with property companies and private equity companies is that it does become really expensive to try and buy some of these assets directly. So what they are resorting to is M&A. So late cycle, you expect M&A, especially script heavy M&A, given that shares have rallied so hard, and that's exactly what we're seeing in terms of the property space, where we've seen a huge amount of activity in 2018.
Yeah, certainly really a lot of action in that property space. Also, we're hearing about a different sort of action in the insurance space and not the good kind of action. So Freedom Insurance has hit another low. I mean, what's your view there? Where to from here?
Oh, this is an absolute shocker, Chris. I mean, this is a stock that kicked off the year at 47 cents, and today it reached a record low of 10.5 cents. And it's actually looking like a smart move by Bank of Queensland earlier this year, offloading its life insurance business, St Andrews, to Freedom Insurance at $65 million. Given that Freedom Insurance market cap is now less than $30 million, I mean, it isn't even that. It isn't even half of sort of St Andrews' market cap when they took over that business. But look, it does look like the whole business is under review, so I'm not sure what's going to happen in terms of Freedom Insurance going forward and their business model, because they have stopped selling a lot of their products. But look, it is the funeral insurance product which makes up most of their revenue, and I think they're still selling that, but it does look like their business model is under a threat of existence, and certainly the share price is reflecting that.
So I know they're very different businesses when you talk about Suncorp, when you talk about AI Group, when you talk about QBE, you know, but they are in that insurance space. So do you see what's coming out of the Royal Commission from some of these smaller players having a direct influence on their share price as well?
Look, I think if you're looking at the wholesale market, there shouldn't be much of an impact, but where there probably is an impact is going to be the direct sales market in terms of insurance. So to some extent there will be an impact and probably more regulation, which of course we know from the banking experience comes at a cost. So you would expect the insurers to see a higher cost. But in the case of QBE Insurance, it's well diversified globally now. So it isn't an Australian-centric story. And most of it isn't direct selling of insurance. But look, unfortunately, regulatory risk is rising in that space and cost is rising, and that tends to put a bit of a dampener on earnings growth, and that's probably what we're going to see from the insurance space. But the insurer is under pressure, and really it's the financial sector that's dragging on the Australian share market, which is causing it to underperform today.
Yeah, financials have lost about 6.8% this year alone. QBE, while we're on it, down by about 2.4%. We've got that hurricane bearing down on the east coast of the United States. So that's obviously a big concern there.
I think the hurricane's actually been downgraded, so it's probably not as big a concern as when we were talking about a Category 4 storm. It's been downgraded to a Category 2 storm. We'll still be watching for damage, but it does look like it's going to be mostly water damage and a lot less than when we were talking about the Hurricane Florence 24 hours ago. So we still have to wait to see the impact of it making landfall, but altogether I guess the fact that it has been downgraded at this stage is a positive. But for the insurance, it really is about some of those yields over in the US, and there's growing talk that we could see an inflection point in terms of the economic cycle. At the moment, US economic growth is extremely strong, but I guess what has the market concerned is the future, and that is the inflection point. When are we going to see that movement from increasing inflation and increasing growth to increasing inflation but slowing growth? And that's I think what has the market worried.
Julia, just finally across across the broader Australian market, we were talking on Tuesday about some bargain hunting, and then that kind of disappeared. I mean, at a certain point, are the sellers going to kind of fatigue here, and are we going to see a bit of a rebound? What do you think?
Look, as you mentioned, we've seen a number of negative days now, and this tends to be a sign of weakness rather than of strength. So I would expect to see a couple of months of weakness here for the Australian share market. Of course, a lot of it is trade dependent, so if we do see a positive resolution to US-China trade relations, then we could see the market rallying, which is why we are seeing markets around the region doing well today, with the exception of Australia. But amazingly, you know, we're looking down the barrel of a 10-year anniversary of Lehman Brothers and having a look at the Australian market and how it's performed since then. We're basically back to where we were 10 years ago. So, you know, we haven't done much in terms of market performance, but it's been the dividends that's helped the market outperformance. So if you include the dividends, and the market's up by 62% here in Australia, but nothing like the US stock market, where the S&P 500 is up by almost 100%. But I think definitely in the last 10 years, it's been healthcare that has been the most impressive, a rise of about 250%. Even though tech has done well, it hasn't even performed half of that, 110% in that time. And look, the worst has been property, as you'd expect, coming out of the global financial crisis, down by 40% in the last 10 years.
Oh, well, great, Julia. Thanks for the perspective. Always appreciate it.